Our goal for today is to help you feel more confident using this tool. And our method today is going to be looking through all the important features of RightCapital that looks at exploring future asset purchases in the current plan and also looking at proposing future asset plans in different scenarios as well. As you know, when we're talking about future asset purchases, a big factor that comes into play is going to be when can we make the purchase and when does it make the most sense for a client plan. So today we're going to be walking through a key aspect before we even look at the purchases themselves is just walking through the settings and assumptions that will impact our future asset purchases in RightCapital. So we're going to walk through how to make sure that those are in line with what you want to see for the client plan and on a global scale. And of course, we're going to walk through building and comparing future asset purchase scenarios. And a key aspect when we're talking about things like property sales or maybe a primary home relocation is the idea that we're going to be investing or reinvesting the proceeds from that property sale. We're going to walk through what that looks like in RightCapital. We're also going to highlight all of those very vital key comparison visualizations that can be leveraged when we're trying to highlight the difference between our proposals, the current plan, maybe the alternative routes that they can take when we're talking about different asset purchases across their lifetime. We're also going to highlight all of the resources that you do have available to you when leveraging RightCapital as a tool in your toolbox. One of those resources being that during this webinar, if you have any questions, please feel free to use the questions drop down and type out your questions there. We're going to answer the questions more towards the end, but feel free to ask them throughout the presentation and type them out in the meantime. And so shifting gears into RightCapital, the first thing that we're going to want to address is going to be those assumptions that I was talking about earlier. So the first aspect, when we first log into RightCapital, we're going to be brought to our advisor dashboard. In our advisor dashboard, if we click on the three dots in the upper right hand corner and under assumptions, this is where we're going to be setting the global level standard for our assumptions and what we're using for our future projections in RightCapital, ranging from asset returns to inflation to miscellaneous assumptions. It's important to note that we're reviewing the global level standard. So when we make adjustments here in our advisor portal, we're going to be impacting any client using global level assumptions, and this is what is going to be used for each individual client going forward, unless we indicate otherwise. Once we open up our client plan today, I'm going to show you how you can customize this on an individual client level as is needed. But right now we want to make sure that our global level is in line with what we want to use for our projections. So under the three dots assumptions tab, if we click on the inflation tab, this is where we're going to see our inflation assumptions and have the ability to adjust them. This is where we can adjust general inflation figures, tax inflation, things along those lines. But the key aspect for today's conversation is going to be something that's selected down below as part of our core values in RightCapital for our projections in the system as advisors. And that's going to be this setting right here, in that what we select and check off if we have a start date in the future for goals, income, savings, or expenses, whether or not we should be inflating those values between today and when the start of the goal, income, savings, or expense happens. So we can check off each individual section here in terms of what we want to show inflating between today's date and when the goal occurs in the future. There are a couple things that are not going to be impacted by the selection because of the nature of the type of future goal, income, savings, or expense, but this is going to be important when we're modeling things like car purchase goals. Things that are not going to be impacted are going to be located under this info mark right here, but that's going to be things like our future income such as pension, annuity, loans, business, real estate income, or our asset property purchase goals. But there are going to be a couple things that are impacted in terms of other types of data entry points. So just a relevant aspect when we're looking at the projections, whether or not we want some of those other types of goals, income, savings, or expenses to be inflated between now and its future start date. Another key aspect here in the advisor portal is going to be under the miscellaneous tab. And this is going to be relevant for when we are modeling the selling or purchasing of real estate property. Under miscellaneous, this is where we can adjust the assumption for the cost of purchasing real estate property and the cost of selling real estate property for our projections. It's also where we can find the living expense reduction that will happen when we have the passing of a client or co-client. But for today's conversation, an important factor is going to be what we have indicated for the cost of purchasing and the cost of selling real estate property. Like I said, this is for the global level standard for your assumptions. And so this is going to be referencing things like those appraisal costs associated when we are looking to sell a property, the closing costs as well. Same thing with purchasing property. There are a lot of different costs that can factor into the proceeds or the cost itself. So this is an important factor to get in line. But let's look at our client plan today, which is going to be the Ron Swanson family. And as we just reviewed, that was the global level standard for our assumptions. I want to point out, especially as we start to work on case by case, and if somebody has a more unique situation or we see a trend for their particular cost of purchasing or cost of selling real estate properties, we can make an adjustment to the individual figure by going to the gear icon in the upper right-hand corner, into settings, and going into other assumptions. From here, we would just scroll down to the miscellaneous fields, and we can change what we have indicated right now is just the global assumptions to customized assumptions. And if we have somebody that has maybe a more aggressive cost of purchasing real estate property or cost of selling real estate property, maybe they have a specific broker that they use when they are going through these real estate deals, you can make that adjustment as needed, especially if we have somebody that's commonly purchasing and selling real estate. This can be an important factor that you can adjust as needed on the individual client level. And when we make an adjustment here in the gear icon settings section within an individual client plan, we are only impacting this particular household. The only time we'd be impacting all households is back in the advisor portal when we were making adjustments to our assumptions tab from there on the global level scale. But now that we have that assumptions in line with how we want to run our projections, let's start to understand the plan for the Ron Swanson family. So if we go to the profile section and under blueprint, just to see a visual summary of where they are currently in their current plan, their current net worth, as you can see, is $3.2 million roughly. They're in their mid 50s and they do have a child. And their net worth currently includes a primary home, an existing rental property, and an existing LLC that Ron owns as well. So these are important factors to keep in mind. We also have some decent goals, including the child's college goal. We have them retiring at age 67, which is going to be a key factor when we're looking at their particular path. And as for income, savings, and expenses, they have some decent income, savings, and expenditure habits, of course. But this is just a review to understand the client plan before we start to proceed with modeling a couple of key aspects for their plan. If we go to the profile goals section, this is where we can start to incorporate any future asset purchases that should be a part of the current path. I want to note that back in profile blueprint under goals, we can also add goals directly from there, but we're going to be focusing directly here in the profile goals section for our conversation today, but they both have similar functionality. So a couple different goals in terms of future asset purchases can be added from the profile goals section. If we click on the add goals button, this is where we can start to incorporate some of the key aspects of everyone's lives, which is going to be car purchase goals. We're going to look at the different property purchase goals, but we can model a primary home relocation and selling a primary home, investment property purchase requirements, vacation home purchases, land purchases, and also home improvement goals. There's also the functionality to add lifestyle asset purchases, which is going to be things like boats, and also business purchases as well. But to start with, we do have a car purchase goal that we want to incorporate as part of the current path for the Swanson family because they do need to replace their car in the future. So let's click on the add goal car section. From there, we can enter the dollar amount for the car itself. We can indicate the owner. In this case, it's going to be jointly owned, and when this goal is going to occur. For them, it's going to be 2026, roughly. And especially with cars, and oftentimes we need to replace cars, and if we do have the habit of having a recurring car purchase goal, we can also change the frequency. So this right now is set to one time, but we can indicate that this is actually happening sporadically over a number of years, every couple years or every 1 year. And we can also indicate how we are acquiring this car. So whether we're purchasing this car up front, or if we're leasing the car, which is really when that frequency comes into play, because oftentimes if we're leasing, we're probably going to be exchanging the lease for another one. That's the path. That's when we're going to be switching up the lease to frequency. And we can also indicate if we're actually financing this purchase. So if that's the case, which it is for them, we're going to select finance. From there, we can indicate how the financing picture looks like in terms of the down payment, the term, the interest rate that's applicable. We're going to assume it's a little bit higher just considering the market today. And then we can also indicate any particular increase as well that should be happening, or if this should be a not inflated car purchase goal. For us, we're going to assume no inflation for this particular goal. So we're going to keep it stagnant for now. And we're going to hit save. Now that we have that indicated, we do have another future asset purchase that we're going to be incorporating that they are evaluating. So if we click on add goal, and under property, they are considering buying a vacation home. So we're going to click on property, vacation home. That's something that's already going to be in the works for them. They're already looking at it for this year. So to incorporate as part of their current path, which is what we're doing right now, we're going to click on that add goal vacation home. From here, we can indicate that purchase price. And when we have the acquirement of a property, we can also specify how we're acquiring it, whether we're inheriting the property, purchasing the property, or if we're converting an existing property. So if this is actually converting their rental property or an additional property, we can just select convert property. And from there, it would be essentially converting it to a vacation home. In this case, they're purchasing one, so we're going to keep that selected. We're also going to specify the owner, whether it's owned by the client, co-client, jointly owned, or put into a trust. We're also going to specify the state location, which is New Hampshire for this situation, and when this goal is occurring. So for them, 2027 is when they're going to be acquiring this new vacation home. And then we can indicate the annual insurance, annual maintenance, and the normal aspects for a property input. And as we are purchasing a new asset, we are going to be indicating how we're acquiring it, whether we are financing this or if we're paying for the full cost upfront at the time of the goal. That's when you keep the down payment at 100%. But in this situation where we're actually going to be financing this, that is when we need to indicate what the down payment is, the total term, and the interest rate. From there, since this is a vacation home, you can also indicate if we are planning on selling this at any point in time within their plan. Right now, the default is just end of both plans, so we can leave that selected if that was the case. Otherwise, we can indicate that this should actually be sold at a specific calendar year after a number of years at one of their major life events. For them, they're only looking to hold this for 15 years and then they're going to sell it. So we're going to indicate that from here and hit save. Now that we have their current path accounted for, let's start to build out one of their proposals and one of their dream goals, of course. So if we just go to the retirement module here under analysis, this is where we start to curate our proposed plans. It's also where we're going to be greeted with the probability of success and one of the gauges of financial well-being. The probability of success, just to note before we dive deeper into it, is going to be looking at the 1,000 trials of market volatility, also known as the Monte Carlo simulations. And it's going to be the percentage of those trials that make it to the end of plan without running out of money. So for their current path, they have a 98% probability of success, which means 2% of the trials do not make it to the end of plan without running out of money. And just to note, the green bar chart directly to the right is going to be displaying the median trials ending asset value from the 1,000 trials. So it's essentially trial 500. So with their current path, they have a 98% probability success, but there are, of course, some dream goals for the client, and that includes downsizing and getting a dream home in Florida for them. So let's start to model that, and maybe a boat purchase goal is also upon the horizon. If they are going to be going to Florida, they also want to account for those dream goals, of course. So we want to start to plan for that. So in the action items, this is where we start to curate our proposed plans. Whatever we indicate here and make a change to is only ever going to be impacting our proposed plans. It's never going to be impacting our current plan. So as you can see, this is where we're going to find a couple of things that are pre-populated here for us. That's going to include some of those current goals in terms of the new asset purchase for the jointly owned vacation home, and also the existing asset sales from our existing rental property and the LLC, which we have being sold at Ron's retirement. But we want to start to build out a new path. So we're going to click on the edit button. From here, we're going to see a screen pop up where we can choose to include or exclude certain action items. So if we have something that's already existing that we wanted to propose a change to, or just see on the action items for reference, we can just check those off. When we do, and we hit save, we're now going to see those items populate in the action items for us to be able to propose changes to. They're all still occurring in the background because it's part of the current plan, but it's just whether or not we want to see it in the action items or propose changes to it. So just for reference, I wanted to include the joint car goal, but let's click on the edit button once again. And from here, we want to propose a new path, and we can do so by clicking on the add new items button. Within the add new items button, we can add new goals, new income, new savings, expenses, insurance policies, and also annuity purchases as well. For us, we're going to be looking at the idea of acquiring their dream home and moving when they retire. So we're going to click on add new items, goals, property, and then primary home relocation. This is going to open up a card for us to start to enter the details of the primary home relocation. The details are going to be the same exact items that we would have entered if we did put this as part of the current plan back in profile goals. But let's start to enter what this current or planned primary home relocation is. For them, we'd enter that purchase price. And then once again, we want to make sure we're indicating how we're acquiring that home. So if we're just purchasing it, we can leave buy a new home selected. But if we're actually inheriting a home, we can check that off here. Or if we're going to be renting a home or moving into an existing home, we can also select that. For them, they are purchasing one, so we're going to keep that selected. And then very importantly, when we have a home relocation, is specifying the state location. So if we're not living in Massachusetts anymore, which they're not going to be, they're moving to Florida. That is a vast different tax picture for their client plan. We have very comprehensive tax calculations, and the state taxes are going to be controlled by this primary home relocation. So when we have this goal occur, which is going to be tied to their retirement, we would see the switch over to the new state's taxes. So we're going to be changing the when from calendar year to their life event of Ron's retirement. We can indicate the annual appreciation value, annual property tax, annual insurance, annual maintenance, and once again, how we're going to be paying for this home. So if we're going to be financing it, we can change the down payment to that percentage, then the term, interest rate. And at the bottom is where we'd indicate what we're doing with the existing primary home, whether we should be converting it to a rental home, converting it to a vacation home, or if we're going to be selling the home. In this case, we are going to be selling the home, and we're going to be using the proceeds to fund this new home purchase, which is why we're going to say the down payment is 100%, and we're going to be automatically reinvesting the proceeds. So let's hit save. And once we hit save, we've now incorporated that as part of their proposed plan. It's important to note that when we have the sale of an asset from businesses to real estate properties, including the primary home, any proceeds are always going to be automatically reinvested into the brokerage accounts or into the taxable bucket at the asset allocation that is either part of the current portfolio or whatever we have proposed. In the action items on the right-hand side, this is where we'll see a strategy for our asset allocation. And this is where we can also propose a different asset allocation. So this would allow for us to create a scenario in which we are selling our primary home and using the proceeds to pay for that new home. And we can also propose that they change their asset allocation to one of the portfolios that we do have. But right now we're going to leave it at current allocation. They do have a boat that they wanted to acquire since they're going to be moving to Florida in this dream goal of theirs. So we're going to click on edit. Once again, we're going to click on add new items, goals. Then we're going to go to asset purchase and lifestyle asset purchase. The lifestyle asset purchase can be a great goal to indicate a lot of different types of purchases. Oftentimes this is used to model a boat purchase or something that's more expensive and tangible like fine art or jewelry. That's going to be part of the net worth. But for them, this is going to be their joint boat. We also want to change the owner to jointly owned, and we're going to indicate the purchase price of this boat. Then we want to indicate when this is going to be occurring. We're going to have this occur at Ron's retirement. And we can also indicate what is happening in terms of annual appreciation. And also a key factor, as we're going to notice when we're dealing with future asset purchases, is going to be the idea that we do have a financing aspect to it. So if we have a situation where we're going to be financing a goal, you do have that option to indicate so within the lifestyle asset purchase as well. So if this was going to be an appreciating asset, we can indicate how much it'd be appreciating with right here. And then we can also indicate the year of sale. For them, they do plan on selling it 10 years after they purchase it. It's a lot of maintenance to take care of a boat, and so they don't plan on keeping it for their lifetime. So we're going to indicate selling it after 10 years. And we can also indicate any cost of sale that's applicable. And that's going to be the case for this situation of 5%. And that's going to go to reduce our proceeds when we do finally sell this boat. So now we hit save. That's going to be baked into their downsizing proposed plan. It's important to note that you will see those existing asset sales and new asset purchase requirements. You can always make the proposal, and let's say we're actually going to be changing the path for when we are going to be selling or purchasing some of these assets. We can make that adjustment via these drop downs or by indicating so in this field. So let's say in this situation, since we're going to be having this aggressive goal of moving to Florida and buying a boat, that our jointly owned vacation home is going to be put off to a later date. We can make that adjustment from here, either tie it to a calendar year or to Ron's age. We're going to do that because it's a little bit easier for us. We know that Ron's retiring at age 67. So we're going to indicate that they're actually going to be selling the vacation home at age 70, and we're going to hit refresh, or they're going to be purchasing the new vacation home at age 70. So now we've incorporated as part of the proposed plan. We can see that impact right here. We do have the rental property that they have passive income coming from. If we wanted to have that be sold at a different time, we can also make that adjustment. Same thing with the business. We do have it being sold at his retirement, but if we're going to make an adjustment to that path, we can do so from here. But for now, let's just focus on the comparison between our downsizing situation, moving to Florida, versus our current plan. From here, we can see the side-by-side comparison between the two in terms of probability success and median trials ending asset value. But there is another very powerful graph that can be used to assist in the conversation when we're trying to analyze the difference between two plans. And that's going to be found under the comparisons tab. Here under comparisons, we're going to see a key visual summary between the comparison of our currently selected proposed plan of downsizing to our current plan. This is going to be an entirely different projection than what we were looking at in the probability tab. So it's just important to note, comparisons is going to be looking at the cash flow level projection, which is a straight line projection, and it's a guaranteed return for the baseline at the very least. You do have the option to indicate modeling different sequences of return and seeing how that impacts this visualization. But for right now, we're going to focus on the baseline, which is a guaranteed return and not factoring in volatility. So here we can see the difference between invested assets between our downsizing situation. We have 4 million more if we proceed with moving to Florida, selling the home and reinvesting proceeds, of course. We can also see the comparison of net worth as well and how that impacts their plan. And we can also see the difference between taxes paid. So you can see that in the scenario we're downsizing, we are paying slightly more in that situation than our current plan. We can also see the comparison between assets at retirement. For them, it's no impact, but we can see those key comparison visualizations. And that's just going to be those graphs that can assist in the conversation to paint the picture between the analysis of our downsizing situation versus current plan. If we wanted to take a deeper dive and see how this looks when we're looking at the more specific cash flow projections, we can do so by going to retirement, cash flows, and we can continue the conversation from here in terms of analyzing our current plan or our downsizing plan. So under cash flows, we're going to be greeted with the maps visual. Before we proceed though, we want to make sure we're looking at the right cash flows. So we can look at either our current plans or any of our proposals, but we want to make sure that we're highlighting the proper one. So let's switch this over to our downsizing scenario. And you can easily switch between the two, downsizing and current plan, if we're trying to compare these two visuals live in person. Right now, we're looking at the waterfall map of their cash flows. This is going to be highlighting a specific year of the cash flows. And this is going to be a nice visual that's easy to digest in terms of where our money is coming from and where it's going to. So especially as we're going to be looking at a couple key aspects that are very important in terms of money coming in and where it's going, which is going to be surrounding Ron's retirement years. So let's toggle to that using the slider, where we can see that that big life event is highlighted for Ron and Amy's retirement in 2037. And we can see where our money's coming in from and where it's flowing to. We can see how much we're saving as well. We can also click on the waterfall dropdown and view the breakdown, which is going to be a different visual summarization of 2037 for us. And so this is where we can see where the money's coming from. Once again, we can click on these drop downs to see the exact proceeds of some of these sales. So we have the sale of real estate or property. We also are selling the business in this year. We also have the rental income that's still coming in because they still own that home. And we can see that total outflows as well. And we can see that net cash flows. But this is going to be a key visual summary of that specific year of the cash flows. The summary tab right here is going to be a great space to look if we want to see line by line breakdown of their cash inflows and cash outflows, and to get very granular in terms of the figures themselves. So for example, if we wanted to see some of those bigger proceeds coming in 2037, we can see under other inflows, there's a huge jump. If we click on the header right here, we can see more insights in terms of where this money is coming from. So a key thing in RightCapital is anytime we see something underlined, we can click into it to see additional insights or functionality. So we can see here that rental income. We can click on sale of real estate and see we have that primary home going on. And we can see that jointly owned vacation home being sold, being purchased a little bit later and sold. And under the goal section, this is where we're going to see some of those other acquirements in terms of the education goal that's kicking on in a couple of years, but also that car goal where we have the down payment coming in, and then we're going to be financing it for the couple of years after that and those payments. And then we can see the property acquirements in terms of the primary home, the new one, and the vacation home a couple of years later, which we're doing a down payment on, so that's why the cost isn't too high. And for the year in which we are going to be acquiring and also selling a lot of assets, we can see what is happening there in terms of our net flows. So for that year, we have a positive net flow. It's a key indicator, and that's going to be just that indicator that we are automatically reinvesting those proceeds. When we're looking at summary, this is focusing on the cash inflows and cash outflows for the client plan. To see additional insights in terms of their account level details, we're going to want to transition over to our Accounts tab. And under Accounts, this is where we're going to see the ending balance by accounts. This is just going to be that space where we can see that growth over time and also what's happening with the accounts. But we can also click on this drop down right here and actually toggle to view additions to accounts, RMDs, withdrawals from accounts, but also net cash flows. So especially when we're trying to highlight exactly what's happening in 2037, see where that money's going, see the addition and any withdrawals later on, which does happen, we can see that those proceeds were automatically invested into the taxable brokerage account in 2037. So this is a great space to see what is happening in terms of additions or withdrawals from any of these accounts. And also just a great space to see the ending balance by accounts and that nice asset accumulation over time. We can do the same thing for our current plan. So if we wanted to highlight those particular cash flows to see the difference of the ending balance by accounts, we can see that kind of comparison right here and just quickly toggle between the two for those projections. Same thing with the summary as well. But going back to retirement analysis, they did have another key idea, and the key aspect for this situation for them is going to be timing. So we're going to create another proposal for them back in retirement analysis. Right now we're using the downsizing one, but let's start to create an alternative proposal by clicking on the pencil icon next to the current plan. When we click on the pencil icon, this will allow for us to add or remove plans that are existing. So if we wanted to add a new plan or copy the current plan, we can click the Add New Plan button, but we also have the option to copy some of our existing plans and build from there. So in this situation, we actually want to copy the downsizing plan and build off of it. Let's retitle this for our ease. So let's see, after retirement downsizing. We can retitle it, hit the check mark to save the name change. And now when we hit OK, we can use this drop down right here to toggle to after retirement downsizing. And we can start to build out our other proposed plan, which is going to be changing the timing for a lot of those things that we curated back in the original downsizing plan. So going in the action items, we're going to see all of those things that we built out in the other downsizing situation are changed for us. We're going to make some adjustments to the timing here. So in this situation, we're talking about the timing aspect and which makes more sense for the client plan. And if we should be waiting until after retirement for the move to Florida. For them, they do have this, sale of a business that's happening at Ron's retirement. So if they wanted to stay and deal with that where they are currently, we're going to be evaluating that particular path for them just to paint some color. So we can change the timing here by clicking on the drop down and changing it to a calendar year. So instead of it being 2037, we're going to wait a couple years and see the difference if we do this in 2040. Same thing with the boat. We're not going to buy the boat before we move to Florida. So we're going to change this to that specific calendar year. And we're going to wait a year to settle and go to 2041. And we're going to keep the sale of the business to Ron's retirement and hit refresh. Once we make that change, we can see how it impacts their property success. Right now, we are comparing against the current plan, which is the idea of them not going to Florida. But let's actually change our compare to our other downsizing situation. So this is a nice way that we can compare and contrast a multitude of different proposals. We have our downsizing one on the right-hand side versus our left-hand side after retirement downsizing situation and moving to Florida. We can see that side-by-side comparison. And we can also make further adjustments as needed as well. So let's say we also are evaluating the idea of them actually selling the rental property. We can also bake that as part of this particular proposal by selecting calendar year. For them, they're going to be evaluating selling it as they move. So we're going to change it to 2040, hit refresh. And we can now see what that looks like in terms of impacting their property success, because that was an idea for their dream goal is not having to deal with managing the property anymore. So you can see that side-by-side comparison under property success. Comparisons is a great space to see that comparison visualization in terms of invested assets and that difference. Same thing with the net worth. We can see what that looks like. We can also see if anything's changed in terms of the tax picture, which for them, taxes are significantly less over time if they pursue downsizing after retirement and selling the rental property. So if that was a concern, we're now kind of evaluating that timing and which one makes the most sense for their picture. And we can also go to cash flows to see that cash level detail as needed. For them, though, they are going to be evaluating another sort of idea, which is that if they are going to be selling the rental property, potentially purchasing a new one in Florida. Because the big thing with the rental property, it's in their current state of residence, which makes it easier to maintain. So if we wanted to illustrate them purchasing a new rental property, we can click on Add New Items, Goals, and under Property, we can add that investment property purchase right here. And from here, we can start to enter the parameters for this purchase. How much it would be. And very important is indicating what is happening in terms of how we are acquiring this particular investment property. So if we are purchasing it, we can enter those parameters in terms of, are we paying for it up front and things along those lines. But there is that unique aspect when we're dealing with an investment property. And if we do have somebody that is frequently doing what is called the 1031 exchange, this is a great way to model the 1031 exchange. So we're going to indicate purchase property for now. We're going to change the owner to jointly owned. The state location is going to change to Florida. We're going to indicate that this is going to be happening at that specific year in 2042. Then from there, we can enter those parameters that are relevant for the property. Making sure we're entering that monthly rent amount that they're going to be receiving, of course. Any rent increase, and also assumed vacancy rate. So this would be going to be impacting directly the rental income we're seeing each year by assuming that there's going to be a vacancy every single year, essentially by the 5%. We can also indicate any annual depreciation that's applicable, which it certainly is when we're dealing with property, and also the down payment strategy. But if we are making a 1031 exchange, we'd want to use this drop down right here for 1031 exchanges, and then we'd select our rental property because that's going to be the one we're using for the 1031 exchange. And we can also indicate the year of sale for this investment property if we do plan on selling this one later on down the road, which for them, we're going to keep that to just the end of both plans for now. Hit save. And since we are going to be doing a 1031 exchange of the rental property, we're going to change this to not be sold before that goal occurs. So we're going to change that input right there, hit refresh. And now we're incorporating the idea of them doing the 1031 exchange for that new rental property that can be with them in Florida, which is easier for them to maintain. So now we can do that side-by-side comparison under probability. Comparison's the same thing. We can see still paying significantly less if we pursued the 1031 exchange idea, which is oftentimes a key incentive for that kind of scenario, is the taxes analysis right here. We can also view the difference in invested assets over time and net worth. And under cash flows, we can also see that occurring as well. And so we can view that for all the different proposals we have, including the after retirement downsizing situation. And so for this situation, it's going to be occurring a lot later for them. We're going to see the other inflows coming in later, age 70, 2040, 2042 for that new rental property that we're going to be acquiring or 1031 exchanging. So there's a lot of great things we've accomplished here. We can see those positive net flows. Once again, the accounts tab is a great place to see the net cash flows and those additions to the brokerage bucket at those different points in time. And now we've walked through a couple of different ways to run that analysis. It's important that we have the key visuals we need when we're doing any sort of presentations. And under the gear icon report section, a very important factor here in the reports when we're downloading a PDF report and we're trying to include multiple plans, especially when we're looking at the cash flows, that you do have the option to do so by clicking on the header of cash flows. From here, we can see that more functionality. We can be extremely selective and very fine-tuned in the way we're presenting the narrative for PDF reports. So if we wanted to highlight the waterfall, the breakdown, the summary, net worth over time, and maybe ending balance by accounts, in additions to accounts, we can make those selections from here, be very selective, but we can also use a select plans toggle. So if we wanted to include all three of the main paths for the client from their current plan, downsizing, and then after retirement downsizing scenario, you do have the option to do so and incorporate that as part of the PDF report. So that way you're covering all those important factors all in one space. Same thing with analysis. We can click on this header right here. We can include the probability, action items, and also toggle to select plans. So if we wanted to include the three different paths from here, we can make that selection and that designation. And maybe we're also including blueprint. And then from there, you can hit the download selected pages to download a PDF report of those selections. You will also have the option to rearrange the flow of the order. So if we wanted to discuss the blueprint first and show what the current plan's net worth is, we can bring that to be the first thing that we address. Same thing when we click on any of these headers, that we can actually reorder the sub tabs in terms of the flow of the narrative in the PDF report as well. So just an important little tip there when we are kind of fine tuning how that presents in the PDF report, that you can make that adjustment. So especially as we start to analyze those three different main paths for the downsizing situation, there is an alternative aspect that they are looking to analyze, which is going to be purchasing a new business when they are in Florida. So if we go to retirement analysis, from here, this is going to be included in the after retirement downsizing in both of their plans. So we're going to go down to the action items and click on edit, and then add new items, goals, asset purchase, and then business purchase. So for them, they're going to want to be continuing to have some sort of contribution and at least still working in Florida. They still want to be doing something. So we're going to model that business purchase as well. So we can indicate that purchase price. Once again, who the owner is, which is going to be Ron in this case, and what type of business. The type of business is, of course, very important in terms of accurately calculating taxation, in terms of especially any distributions coming from the business itself. For them, it's going to be an LLC as well. And we'd indicate when this is going to occur. This is going to occur in 2042. Any annual appreciation, which it should be growing hopefully, and also annual income and annual distributions. It's important to note, and this is going to be relevant for even when we are entering this in the current plan, back in profile net worth, that the annual income and annual distributions fields typically might be the same, but there is a key distinction between the two. When we're looking at annual distributions, this is going to be the amount that is received from the business, and this is going to be reflected in the cash flows only and is not included as a taxed income. The annual income field is where we indicate the dollar amount that is going to be a part of the tax calculations for income, but is not included in the cash flows as an inflow. So that can be a couple of different things can happen in terms of why the numbers might be different, including business expenses impacting the actual cash inflow versus the tax picture. But for this situation, we're going to be assuming that the income and distributions are the same. So the tax picture and the cash inflow are going to be the same in this situation. For them, it's going to be $30,000 a year when they start out. And then we're going to have some pretty aggressive growth in terms of the salary increase, or AKA the income distribution increase. And we can also indicate how we're purchasing this asset. Once again, if we're taking out a loan for this, we can indicate that down payment. In this case, it's going to be a little bit more unique. We're going to be assuming 50%. We can indicate that loan term and the interest rate of acquiring this business. We can also indicate the year of sale. So for them, this is going to be a short venture. We can indicate after number of years, 8 years, And we can also indicate the cost of sale and also how we are going to see the proceeds of this business sale, whether this is going to be a lump sum payment or if they're actually going to receive the payment for this business in installment years. For them, we're going to see a lump sum payment and we're going to hit save. So now we just incorporated that other business purchase with the idea that they are going to be selling their other business before moving to Florida. So now we can see that side-by-side comparison between the two situations. Same thing with comparisons. And under cash flows, we're going to see a very different picture, especially under summary. And especially if we wanted to see those income inflows and the business income, we can see that their current company, what's happening there. We can see that increase in terms of how much they're receiving from the other business. So this can be going to fund their expenditure during retirement. And this can also be included in the PDF reports as well.